Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kirkendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 7 years and running, celebrating their 30th year, serving North Central Florida savers and investors, helping you achieve your financial goals. Ladies and gentlemen, the team from GulfCoast Financial Services, founder, CEO John Kirkendall here with us, providing that common sense guidance with our money, helping to clarify and uncomplicate the financial world, which, John, is no small task these days. People reasonably concerned about the market, I think.
Well, that's right, Peter. It's certainly interesting right now. We have so many different things that are affecting the market that people are concerned. You know, I got a email just before we started this from a client of mine who's in their late 80s, and they're asking me if they need to sell their car because they're afraid they're not going to be able to make payments on it. So, I mean, that's the kind of reality that we have today, that, you know, the majority of retirees haven't saved up enough money for retirement. And there's a huge amount, I think almost 60%, that are living on Social Security alone. And when you've got the market doing what it's doing, we know that all of a sudden that reality of seeing your money go down and at the same time trying to live with everything that's going on right now is tough.
And then ironically, John, I think that the thought process a lot of times and sort of what we have been taught and trained is, well, I'm not sure if I have enough, so I need to take more risk with what I do have. Mm-hmm. And it just seems like just saying that out loud seems counterintuitive to me.
Well, that's right, Peter. I mean, if the market's volatile and if we're losing ground, we can't afford to take more risk because it's going to take more money for me to get back to zero or back to where I was. And at the same time, if I'm pulling money out, I'm just compounding the problem. That's why when we do that income plan, Peter, we try to set up different buckets so that we don't have to take money out of the growth bucket when the market's reacting like it is right now. And it looks like this market's going to be like this all year long. I mean, we're on a virtual roller coaster. We're up one day, we're down the next day, then we're down 3 or 4 days, and people are honestly, genuinely concerned.
Yeah, and unfortunately, the dips and dives and loop-de-loops, that's our money riding those roller coasters. And sometimes it may get stuck at the top. Sometimes the lap bars may unexpectedly open up. It just feels like the bottom could drop out at any point in time, kind of like we're in the front car, just leaning over that cliff, about to take that first big downhill turn. But John, the reality is that market downturns are not unusual. They should not be unexpected. In fact, the relative stability and continued upward direction of the market over the past 10 to 12 years really is the unusual element of the market and the recent market environment that we've seen. Volatility is normal. It's par for the course.
Well, that's right, Peter. But the problem is that we haven't seen this since 2008, 2009. I mean, we've had a little bit of volatility from during that time, but the thing is we haven't seen anything like we've seen recently. We haven't seen inflation being 8-9%. We haven't seen cost of goods going up dramatically, groceries costing more. We haven't seen all the things that have created, I like to say, this perfect storm. But you know as well as I do that every 6 years we have a bear market on average since the Depression, but we haven't had one now for a long time.
It's just recency bias. It's what our mind can store and retain. And I know somewhere in my mind, like all of my friends' names from elementary and middle school are stored as well as like random movie quotes, but our mind can only hold so much. And so we store the most recent information. And so this feels like something that is new when we do experience market volatility. And John, relatively speaking, we are still in the range of all-time highs. I mean, the market is still way up there. But because we haven't experienced this volatility, I think that it is unnerving and unsettling for many that really don't want to suffer market losses and declines, don't want to go through another bear market cycle. So are you hearing from people who are worried? Do you think that worry is valid? If so, and where does the conversation go from there as far as an approach?
Well, I think I am hearing from people that are worried. I think any retiree who is living off their own paycheck is concerned about the market. But what we have to understand is you and I have been preaching now for a couple of years that we have to know our risk. We have to be able to live with our risk. We have to be able to handle downturns in the market. And we need to have different buckets, reserve funds, and we need that income plan. All those things kind of level this out for us and don't create the problems for individuals. So I have a lot of clients who don't call me because they understand what we're doing. They understand that their risk is set so that they can live. We don't have too much, but we have some, because without risk, we can't have reward. But you can't, as you said earlier, you can't have so much risk that because of the way the market is, you don't time the risk with the market. You time the risk with your portfolio and what you're living to live with. As I've always said, the risk for everybody is how much I can sleep at night, knowing that my portfolio could down, but I can still sleep. And if I can't, then I've got too much risk. But too many people have lived too long in an up market where things are good. They haven't reallocated their portfolios, and now they're concerned because they're losing money.
Unfortunately, John, the problem is that right on our investment statement in bold print in red, it doesn't tell us your risk is significant, your risk is minor, your risk is non-existent. It doesn't lay that out, but that's why we turn to a financial professional or team of professionals like you have at GulfCoast Financial Services. I mean, you've got a trained eye. You've been in financial services at GulfCoast Financial for more than 30 years now, and in financial services in total, almost 50 years. So you've been able to see different economic conditions, and you, along with some of the tools and the software and the analysis that you can perform, can really drill down on the level of risk that we have in our portfolios and our investment accounts, correct?
Well, that's right. Back in 87, when we had that big downturn in 87, we didn't have the computers and the tools we have today. So even if you look at 2008, 2000, 2002, we have the tools today to drill down on your risk, to figure out how much risk you can take. And also, we can look at your portfolio and make some changes in reallocations to it. But I think that this isn't the time to get my statement, say, I lost money, and put it in the drawer. This is the time to take action and be proactive for this year.
Well, and for many savers and investors, John, especially those that may have seen a time or two like this before and may have even weathered those times, they may look back and say, hey, the recency bias is that the market has gone up fantastically for the last 10 years. But I do recall that when we had these times before, that I was able to make it through. But the last time that we had a really significant kind of downturn event, the Great Recession, or the time before that, the dot-com bubble, that was 13, 14 years ago. That was 20 years ago. It's different now. Maybe not because the economy, we should expect something different, that it will behave differently, but our situation, our individual circumstances are different and may lead to a conclusion that perhaps we should take a different approach this time around. Would you say that's accurate?
I think that's accurate, Peter. I think for one thing is we're living larger. We're living more extravagantly. I mean, all of us are compared to what we were living 20, 30 years ago. Mm-hmm. And so because we've been prosperous and we've had this great build up in the market, our portfolios have grown. We're now living in more expensive homes. We're driving more expensive cars. We're doing things that are more expensive. So it's taking more of our money now to make ends meet in our own living world. So what we need to do is reevaluate what we're spending. Maybe we don't need to do everything we wanted to do right now. We need to take time to wait. As you know, since the 2000s, the dot-com bubble, and even since 2008, we've come up with that scenario of the sequence of returns. And so if I'm drawing money out of my growth bucket and the growth bucket is down, my money's going to run out quicker. I need to have alternative sources, or I need to cut back on my living right now. Now's not the time to take a trip around the world, maybe next year. But we've got to take a look at everything because, it's taking a lot more to live now than it did 20 years ago.
So should our expectations for what we can or can't do or afford to do be dictated by the direction of the market, John?
Well, it shouldn't be, but in most cases it is, because most people have lived or died by the market.
That's just the reality of how we have things set up in American society today.
Yeah, I mean, we're all thinking the market's going to return. What's that old myth? The market's going to average 10% every year.
10 to 12 is what I hear. Yeah.
Yeah, my money's going to double every 6 or 7. I mean, it's great. And when that happens, it's great. And the market will come back. I mean, if you look historically, if you take the long look, the market is straight up, but it has dips and valleys in it when you look at the short run. And so we're going to have times like this. We have to be proactive. This is a little bit more like the 80s because we've got hyperinflation. I mean, what do we have? 10% or 8% for February? Mm-hmm. I mean, that's a large number just for 1 month. When we've been averaging 3.8 historically, that's a big jump up. We've got a different labor market now than we've ever had. And we're coming out of a 2020 pandemic that created chaos in the marketplace, shut down numerous businesses. And I forgot the number. There's like 3.2 million people that didn't come back to work. But I read a statistic that's really interesting. Everybody says, well, I'll just keep working. I don't have to worry about savings. But 64% of the retirees surveyed had to retire early because of medical reasons. So we're not going to be able to work forever, people. We need to understand that. And we need to be ready. And the income plan is what's going to make you comfortable through these times.
Talking with John Kirkendall, President, Founder, CEO at GulfCoast Financial Services. And if you've got questions, if you would like to evaluate your risk, run an analysis on your plan, construct and set up that plan, pick up the phone and give John Kirkendall and GulfCoast Financial Services a call, 386-755-9018, 386-755-9018. John K. Does anybody call you John K? Do you have any nicknames, John?
No nicknames.
But you got 3 generations under the roof as planners there at GulfCoast Financial Services. So do you ever hear dad or granddad around the office?
Papa.
Okay. All right. In this segue segment of get to know John Kirkendall a little bit better. Well, John, I guess one of the problems that is additionally adding complications is the way that not only is the stock market showing volatility and losses to begin 2022. But the bond market and fixed income is also down almost the same amount. We tend to have been taught, and it has been generally accepted for decades, that these two different asset classes, equities, stocks, and mutual funds versus bonds or bond funds, don't correlate. They don't move the same direction at the same time, or at least they offset one another to help to navigate volatile markets. But what we're seeing is that they're really more correlated now than they have been traditionally or ever before. Is that adding an additional wrinkle of difficulty into navigating these markets right now?
Well, that's right, because we don't have a place to really a safe haven. I mean, what's really a safe haven right now is energy funds, energy stocks. They're doing well because, of course, gas prices went sky high. But so with the bonds actually being negative, stocks being negative, we can't go to bonds and pick up that yield that traditionally we've been able to go to. Even high yield aren't doing anything. So we don't have that safe haven that we can go to. What we have to do is we have to find other alternatives like energy funds, commodity funds. There are certain segments of the market that have been able to hold up, medical somewhat. So we have to be able to go into some different things in order to keep our portfolios receiving dividends and at the same time not losing a lot of money. Interesting thing I wanted to tell you about, my son just got a bid on a new truck. He wanted to buy a new truck. And of course, you know, you can't go down and pick one out anymore. You got to order it. And so they were going to give us low trade-in on his truck, which is a great truck. And then they're going to charge us full retail on their truck, which great deal for them, right? But they're only going to give us 6 gallons of gas. Now, you know, back in the day, they'd fill your tank.
They would
right?
top it off, yeah.
Yeah, 6 gallons of gas. That's how valuable gas has gotten.
It's an interesting world that we live in. John, the problem with the fixed income and the equities, what has been considered more conservative? I think that the conditions that we're seeing right now really emphasizes the fact that just because it has been considered more conservative does not mean it is safe. Conservative does not equal safe. And if we are truly a conservative kind of financial investor, I know investing by definition involves risk, but the conservative is risk adverse, we may need to look at some other alternatives because we're not in a time where the past performance of bonds or fixed income is really playing out and repeating itself at this point in time.
Well, that's right, Peter. And, you know, there are the fixed interest rates. So therefore, fixed annuity rates have gone up. Also, the fixed indexed annuities are a place to go because I can put my money there and hopefully make money, but the insurance company guarantees me that I won't lose principal. So there are some alternatives. But, you know, if you're in a target fund and you think that target funds are safe, target funds are losing money right now because bonds are down, stocks are down. So even if I'm in the shortest target fund, which is supposed to be made up more of fixed equities, I'm not making money.
And there was an old saying that history does not repeat, but it often rhymes. This is something that we've seen before. Target date funds have sort of a preconceived formula, an algorithm that is supposed to reduce risk by moving a greater percentage over to the bond or fixed income side as we get closer to a retirement date out in the future. But in 2007, 2008, I believe that we saw a similar kind of problem with target date funds, that stocks and bonds were both losing value at the same time. And even with a target date fund that was in the relatively near future, only a few years out, there were actually significant losses because they don't adjust for conditions. They only adjust for that predetermined formula.
That's right. They're looking at when I'm supposed to retire, and the sooner I'm supposed to retire, if I'm looking at like a 2022 or 2023 target fund, it's going to have the majority should be bonds because that's perceived to be safer. And you're right, 2007, 2008, those funds were losing money because the stock market and the bond market were both down, just like it is today. And so that's you need to review those funds, review that situation.
And again, it's something that oftentimes we are putting on autopilot, which is a benefit because at least the savings gets done. But the place I most commonly hear about and see those life cycle funds or those target date funds is inside 401ks, where the 401k is set up to help us save and invest automatically. It's done on autopilot, and kind of an autopilot within an autopilot, there are the target date fund options. But sometimes, John, if we're not paying enough attention, if we're not really proactive, then opportunities may get missed, or we may encounter trouble that we don't necessarily have to encounter. So taking a look at these things, reviewing them with a trained, experienced, qualified professional may present us some opportunities, some benefits, or at least shed some light on some other alternatives to simply riding the direction of the market wherever it may take us.
That's right. And you got to remember, Peter, if I lose 20% of my 401k, I've got to make 25% just to get back to zero. Now, on top of that, then I can start making money. So just because the next year I make 25 or 30% doesn't mean I've made a lot of money. It just means I'm back to zero where I was, and I can start over. So I could lose 3 or 4 years of growth just trying to sit there and let my portfolio go down.
And those downturns and rebounds, John, again, recency bias. The most recent experience we had was COVID. That rebound happened unusually quickly. They normally don't. Typically, it is not a straight down loss of 30% or however much, like the 11 days during the COVID onset. Oftentimes, those bear markets take more than a year, kind of a slow bleed from the peak to the valley, and then can take potentially several years to recover and get back to break even. Good news is that the market has always not only recovered, but surpassed previous highs.
Yes.
But do we have the time to go through that process?
Well, if you're getting close to retirement or you retired, you don't. Because, like I said, in retirement, we're using our own money. And so it's whatever we save. I think the average amount that a retiree is saved is something like $172,000. That's the average amount for all retirees. That's not a lot of money when you look at an average. Now, you got to remember there's some people with $2 or $3 million, and there's some people with 20 or 30, but the average is 172. That is not a lot of money. We can't afford not to be proactive. And you're totally right. The downturn we had during COVID was a V. It went down, it came right back up, and we came right back up in 2 months. So we really didn't feel any pain. We felt it going down, but boom, we were back to even. So this is going to be a much more prolonged thing. There's more pain to get yet to come, and we've got more pain this year to get through.
Well, historically, the market has certainly been a great tool and shown growth, provided gains over time, but there have also been times with headwinds and choppy waters, and we are seeing a little bit of that right now. And if that has you concerned, if you've got any kind of anxiety about where the market is, where your account balance is, and your life savings may be heading if we continue this direction throughout the year to come or into the future, then you need to get a review and assessment. Handle that proactively. Take some action to really assess your risk. John Kirkendall and the team there at GulfCoast Financial Services do offer that forensic financial analysis. They'll help you understand what you own, how much risk your portfolio, your accounts, your life savings is exposed to, how much you're paying in fees, costs, expenses, what the tax liability may be, and how to structure that retirement income plan. They do this on a complimentary basis, this initial review consultation. You can call and request that. Pick up the phone, give a call, 386-755-9018. That's 386-755-9018. 386-755-9018 to set up a time, a conversation with John and the team there at GulfCoast Financial Services, and feel a little bit more confident and knowledgeable about your money. John, anything else that we need to hit on about current market volatility that we're seeing and what maybe proactive minded but worried savers and investors need to do about it?
Well, first thing we need to do is actually do something. We can't procrastinate on this. We need to know where our portfolio is, what it's made up of, and we need to reallocate for this time. Overall, everything's going to be fine. We'll come back out of this like we always have. In the 80s when we had the 20% prime, we survived that. We'll survive this. This is just unusual because we haven't been through it in a long time. But it's been there before. History repeats itself. You know that.
And tomorrow then comes. So we need to be prepared for that. Understanding your money, more informed people make better decisions. So get that understanding and the help and assistance where you're filling in gaps or planning strategically with the help of a team of trained, experienced financial advisors and planners there at Gulf Coast Financial Services. Give them a call, 386-755-9018. That's 386-755-9018. John, a pleasure, even if it's a difficult topic. We appreciate your guidance and take on it.
Well, thank you, Peter, and I hope you have a good week, and let's pray that the market does a little better.
Indeed. We'll talk to you next time here on Financial Focus.
Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kirkendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.